Howdy, everybody. Welcome to Liberty Call. Today is Monday, March 10th, 2025. Hope you're having a fantastical day out there in the interwebs. It's a beautiful day here in Colorado. The temperature is like in the 60s. It is cool breezes. It is gorgeous outside. And I'm stuck in here doing meetings all day. So it's the way it is. All right. Well, I apologize for being a little late. I had a meeting last hour and I had to get everything ready. And so here we are. All right. Well, markets are in full-blown sell-off mode with the Dow plunging 890 points, the S&P dropping 2.7%, and the NASDAQ collapsing 4% as Trump's latest remarks fail to ease recession fears. Tech stocks are taking a beating with Tesla sinking 15% and Apple, Microsoft, and Amazon all sliding. Meanwhile, bond yields are dropping. Redfin is soaring 75% after a buyout from rocket companies, and Novo Nordisk is down 7% on weak weight loss drug trial results, and Bitcoin has tumbled below 79,000. Oh my goodness. So before we break it all down, I need some help from you. If you give me some thumbs up, like, share, subscribe, follow, and press that notification bell. All righty. Well, let's get to the markets for today. Dow Jones was down 2.08%, 889 points. Closed at 41,912. S&P 500 down 2.69%, 155 points. Closed at 5614. NASDAQ down 4%, 727 points. Closed at 17,468. The VIX was up 19.21% today. It's at 2786. Canada down 1.53. Brazil down 0.41. And Mexico down 2.11. So we've seen a lot of red today so far. All right, let's head to Europe. Germany down 1.69%. The UK down 0.92%. France down 0.9%. The Netherlands down 0.97%. Spain down 1.32%, Italy down 0.95%, Switzerland down 0.67%, and Portugal down 1.19%. Russian exchanges, they're in the green today. The MOEX up 1.15%, RTSI up 2.01%. And the overnight markets, the Nikkei in Japan was up 0.34%, Australia up 0.18%, New Zealand flat at 0%. China, the Shanghai was down 0.19%, Shenzhen component down 0.17%, China A50 down 0.53%, DJ Shanghai down 0.14%, Hang Seng down 1.85%, and the Taiwan weighted down 0.61%. Ugly days, ugly days, ugly days. Why did I click that button? I did not mean to do that. There we are. All righty. Well, let's hop into our weekly economic update and see what's going on there. Stocks continued their slide through a volatile week. U.S. trade policy drove much of the market's movement, broadening investors' concerns about the economic growth and inflation. The S&P 500 declined 3.1% last week, while the NASDAQ dropped 3.45%. The Dow slid 2.37%, and the overseas markets were up 2.85%. Tariffs take effect. Big price swings and tariff uncertainty loomed over the entire week. Stocks opened lower out of the gate after the White House confirmed the planned 25% tariff on Mexican and Canadian goods would go forward. Soft manufacturing and construction data also put broad downward pressure on markets. Meanwhile, European stocks continued to rally on anticipated defense spending. Stocks fell further as tariffs affected Canada, Mexico, and China. Each country announced retaliatory tariffs of their own, further fanning inflationary fears among investors. By Tuesday's close, all three averages were down 3% for the week, and the S&P 500 had given up its post-election gains. Markets rebounded midweek after the White House announced a one-month reprieve from tariffs for North American automakers complying with the existing United States-Mexico-Canada agreement, the USMCA. The recovery rally built momentum as the administration hinted that exemptions for other sectors could follow. However, as trade policy fatigue rose again, the rebound reversed despite the White House pausing more tariffs on Canadian and Mexican imports until April 2nd. Comments from the Treasury Secretary defending U.S. tariffs and downbeat economic reports put further pressure on share prices. The NASDAQ entered correction territory for the first time in 5 years. The S&P 500 hit its sixth consecutive day of plus or minus 1% price swings. Stocks continued to fall after an underwhelming February jobs report. Later, markets rebounded after Federal Reserve Chair Jerome Powell said that the economy, quote, continues to be in a good place, end quote, and that the Fed was holding firm on current rates. The S&P, Dow, and NASDAQ all finished Friday in the green despite being down for the week. All right. Under the hood, the Institute for Supply Management published fresh manufacturing data on Monday. Although headline numbers were decent, a closer look revealed that new orders dropped in January from its years long high into correction territory, while deliveries and prices paid jumped. Key economic data this week. Tuesday, we have job openings and the NFIB Small Business Optimism Index. Wednesday, Consumer Price Index and the federal budget and Treasury announcement. Thursday, the Producer Prices Index and initial jobless claims. And Friday is consumer sentiment. Just two companies reporting earnings this week. Monday, Oracle Corporation, and Wednesday is Adobe. All right, so that is everything. God, did it again. Did it again. Got to click that button right there, Ray. All righty, well, let's get into our market recap. Here it is. SP 500 slumps as recession fears grip Wall Street. All right, the SP 500 slumped on Monday as investor sentiment soured over growing concerns that President Donald Trump's aggressive tariff policies could tip the U.S. economy into a recession. Well, I hate to break it to you folks, we were headed to a recession regardless of tariffs or anything else, because all we did was postpone the recession 5 years ago when we printed all that money, and it's here right in front of us right now. Markets reacted negatively after Trump, in a Sunday morning futures interview on Fox News, refused to rule out the possibility of a U.S. recession in 2025, as if he has any control over that. He described the economy as being in a, quote, period of transition, end quote, due to his sweeping trade and fiscal policies. Last week, Trump imposed 25% tariffs on Mexico and Canada, only to later exempt most goods for a month, creating uncertainty about his trade strategy. Meanwhile, increased tariffs on Chinese imports have already triggered retaliatory measures. Looking ahead, Trump plans to implement worldwide reciprocal tariffs starting April 2nd, adding further market uncertainty. Adding to trade tensions, newly elected Canadian Prime Minister Mark Carney, a former central banker, criticized Trump's tariffs as a, quote, attack on Canadian workers, families, and businesses, end quote. Investors are also bracing for Wednesday's Consumer Price Index report, which will offer the first full inflation reading since Trump's return to office. Economists expect inflation to cool slightly, with year-over-year rate dipping to 2.9 from 3%. This data will be crucial for the Federal Reserve ahead of its March 18th to 19th meeting, where policymakers will decide on the future of interest rates. I would guess they're not doing anything. Additionally, the job openings and labor turnover survey will provide insight into labor demand following Friday's weaker than expected jobs report, which showed the economy added 151,000 jobs in February, while the unemployment rate edged up to 4.1%. Tech stocks, particularly semiconductor giants like NVIDIA and Broadcom, led the broader market decline amid growing concerns that economic uncertainty would curb enterprise spending. Tesla plummeted over 15%, extending recent losses that erased all of its post-election gains. Meanwhile, Oracle is set to report earnings this week after Trump announced that the company, along with OpenAI and Japan's SoftBank, would make a major investment in AI infrastructure. Other key earnings reports include Adobe, DocuSign, Dick's Sporting Goods, and Kohl's, which will provide insight into consumer demand. In the pharmaceutical sector, Novo Nordisk fell about 10% after disappointing trial results for its weight loss drug. With tariffs rattling markets, upcoming inflation data, and uncertainty around economic policy, volatility looks set to continue. All right. Awesome news, isn't it, folks? All righty. Last up, got the Monday Morning Outlook from our friends over at First Trust. Mr. Brian Westbury's article for this week is titled, "It's Not All About Tariffs." Alrighty. While tariffs are often blamed for recent market turbulence, they are not the sole factor behind the volatility. Stock valuations are historically high, with multiple key indicators such as the Buffett indicator and the Shiller-Cape ratio signaling overvaluation. Several valuation models suggest that the market is expensive. The Buffett indicator measures total market cap of the SP 500 as a percentage of GDP. This current reading suggests overvaluation. The Shiller-Cape ratio compares stock prices to 10-year inflation-adjusted earnings, showing that stock prices are at high multiples. The Fed model compares stock earnings yields to bond yields. Currently, stock returns relative to bonds are at their lowest level since the 2000 dot-com bubble. and capitalized profit models. Discounts corporate earnings by the 10-year Treasury yield, also pointing to overvaluation. However, not all stocks are overvalued. The SP 500 is dominated by 10 mega cap stocks, which make up over a third of the index's total market cap. When these stocks fall, the rest of the market struggles to offset the decline. The SP 500 is still expected to finish 2025 around 5,200. However, unless corporate earnings grow faster than expected, above 10%, or the 10-year Treasury yield drops below 3, the market will remain overvalued. Trump's policy changes, such as tax cuts, deregulation, and shrinking government bureaucracy, are expected to boost long-term economic growth. However, the short-term effects could be very painful as the economy adjusts after years of artificial stimulus from large deficits and loose monetary policy. A similar situation occurred in the early 1980s under Ronald Reagan. While his policies led to long-term economic expansion, the initial transition was painful, particularly in controlling inflation. When Reagan took office, the SP 500 PE ratio was around 8. In contrast, when Trump returned to office, it was 28, suggesting that markets were already highly valued. The recent market correction should not come as a surprise. Investors have become accustomed to buying the dip, as stocks have consistently trended upward in recent years. However, high valuations suggest that easy gains are over, and investors need to be more selective. Rather than abandoning stocks altogether, investors should look for undervalued opportunities, particularly in sectors less affected by current overvaluation. The market may be volatile, but smart investing remains possible. Totally agree. All right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'll be happy to help. All righty. Well, I hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.